Malcolm, how you doing?
I'm good, man. I think it's rude to say out loud that I'm glad Thanksgiving is done, so I won't say that out loud. But holidays sometimes can be a little draining. So
Yeah.
if I was the kind of person that would say those kind of things out loud, that's what I would say.
Are you I think you might be an introvert. Are you an introvert? Because I meet people over Thanksgiving where it's clear that they're gaining energy by being around a bunch of people and having
Mhm.
conversations for hours and hours at a time. I feel a little like I love it. It's good. I feel a little drained by it by the end of it.
Yeah, so you're describing my wife. She's that person who,
Okay.
like, her whole everything gets fed by having millions of people around her. To answer your question, I'm an introvert who masquerades as an extrovert.
Okay.
Yeah.
Yeah. It was my Thanksgiving
That
was
sounded really philosophical. I might need to bottle that. Or put it on a shirt or something.
I think you admitted to a lot of listeners that you're fake by saying I masquerade as something that I'm not. It's like who else is the real Malcolm versus what he's presenting himself as?
No, I've gotten really good at turning off the part of me that wants to be at home sitting on the couch blocking out the world so that I can earn a living.
Okay. Yeah. I think a lot of people do that. I think the way you show up to your professional self may be a little bit different. And since you're such a good extrovert, my Thanksgiving was pretty good, Malcolm. It was good. Good seeing family. We went to go see a concert, which was it was Bela Fleck, and we got a surprise band with them, which was a Siberian throat singing act.
Wow.
And I don't know if you've ever seen throat singing.
I've never even heard of throat singing.
You can do it. It's like it was
and you
impressive.
can be a professional at that.
I didn't know. I think there's like 3 people who get to be a professional, and you perform for Vladimir Putin in 2007. And then you go around and do your thing as sort of like a worldly music thing. But I think it's tough to break into, but if you want to break into it, I don't think there's a lot of competition.
That feels to me like being a professional breakdancer. Like there's just or a beatboxer even. Like there's just some things that like you slap the word professional on it, and then I just have to raise my eyebrow.
Okay, well, I'm gonna send you some clips after this, and you'll find out why they're professional.
One thing I'll point out though, my fellow extrovert, is that you tend to find yourself at live events far more often than most people that I know.
I love anything with the ticket, but that doesn't necessarily mean that it's an extroverted experience. I go to a lot of movies. That's not an extroverted experience. I like talking to people with like a focused conversation for extended periods of time. I think it's a lot of the soft social interactions is when I feel myself a little more drained. So when it's a lot of different light conversations with a lot of people, that's when I think I find myself getting a little tired.
That's fair. I too. I get my fill on small talk very quickly, and I'm just like, either I'm about to offend you and ask you a super personal question, or I'm just going to ignore you and count the hours until it's time to go home.
Or the other trick you can do is you just bring up the Epstein files, and most people, when you do that, they're like, all right, I'm good. I don't want to have even though it's not a political thing, it was bipartisan. People tend to say, all right, I don't really want to get into that right now. I'd rather talk about how your job is going or how school is going or how the job search is going. Malcolm, you want to do the show?
Yeah, count me in that bucket. Watch this transition.
All right, on this episode, we're going to talk about some red flags from the American consumer, maybe Nvidia as well, although I think Malcolm disagrees with me on that. And then we'll finish it up by talking about Disney and Paramount, looking at some media stocks. So normally, the story, the big story, would not be a poll of 280 people, Malcolm, but I thought this was pretty shocking. We were talking about this a little bit early last week, and it was a Harris poll of high-income Americans. So of this subsect, they talked to about 300 people that were earning $200,000 or more. I'm going to throw a bunch of findings at you, and then you can react. How about that? Mm-hmm. Nearly 1 in 3 of well, I guess that would be 6-figure. So I guess that is 100K and up. So nearly 1 in 3 6-figure earners say they're stretched, struggling, or drowning financially. More than half of 6-figure earners say the American dream no longer feels attainable. And then this was the most shocking to me. And this is the 200,000 income cohort. I should have put that at the beginning when I went from 200 to 100. I hope you're following me with the math. But this group makes $200,000 a year. And about half of them say that they have used buy now, pay later plans for purchases under $100. That one was really surprising to me.
I find that amazing. And also, I hate to sound judgy in saying this, but I find that amazingly sad. Because BNPL, I appreciate BNPL because I would not have a Peloton treadmill sitting in my garage if it wasn't for Affirm. Like literally, I was looking online. I saw that I could get a Peloton for, I think it was like $59 a month or something, 0% interest. And that was that. It showed up at my house within like a week. And I was like, oh, this is great. This is the best like transaction I've ever made. I've never used it since. But that thing was like $4,000 or $3,000. It was something ridiculous like that I never would have spent on a treadmill under normal circumstances. So it did its job in that case. It helped them sell the inventory. I was willing to take that because in my mind, 0% interest means you're paying me to take the thing off your showroom floor. So a big ticket item like that, I'm more than happy to take it. But I couldn't imagine using that same structure to pay 15 cents a month for a purchase of $100 or less. That just seems insane to me. However, I guess if I don't know how to manage my cash flow properly and I want to continue to look like a person who earns $200,000 is supposed to look in my mind, then this is my lifeline and the thing that helps me continue to flex at brunch and everywhere else that I go that people ooh and ah over the thing I just bought.
My first reaction to it was, I wonder if these people are lying. Like, is this a legitimate poll? Because, I mean, I remember this was...
Would you confess to something like that if it wasn't true, though?
I know. It was like, okay, so this was back in middle school. Shout out Loveland Middle School. They would do these polls where they would ask everyone in the school, what drugs do you do? Which they were trying to get an accurate sample to see how the drug education was working. But then they ask me, and I want to look cool. So I write, pot, LSD, heroin, cocaine, every single drug that I can think of. So I could just like soil the water a little bit. I think they took it out, but I guess they asked 280 people and they're using this for less than $100. I guess this is people in very high cost of living areas.
You know, I was going the opposite direction with that. Okay. I thought when you said somebody's lying, you meant these people don't actually earn $200,000.
That could also be true.
Not that these people are lying saying they use BNPL.
But the weird thing about the survey is that the people who say they earn $200,000 are using BNPL significantly more than the average American. So that could also be a case where I really hope it's not true, but it appears to be concerning.
But I have read that, though, that one of the things that kept the BNPL bubble, if you will, from popping way back when, I think 2022 was when this was supposed to come to a head. The thing that kept that from happening was the higher than average credit worthiness of the users of BNPL systems. So Klarna, Affirm, whatever the other ones are that aren't as important as those two. Like those names, somehow, some way, I don't know how exactly they managed to skew in that direction to only work with the more affluent borrowers. But I guess maybe it's like if you have an American Express Gold or Platinum card, then you can also use BNPL. I don't know. But that logic would make sense then, that those are the heavier users because they're the only ones who can get approved for these platforms.
So to put the bubble, the growth in context, I don't know if it's a bubble. Buy now, pay later. This is New York Times reporting, said that it was used for $2 billion in transactions in 2019 and $120 billion in 2023.
My God.
And the amount of like laws and regulations around this seem to be a little bit of a question mark. I don't see the advantage to doing this versus a credit card where at least you get travel points and you can, build your credit a little bit. I don't think that happens with buy now, pay later. Go ahead.
Well, BNPL, I just saw an announcement January, February of this year. Affirm, at least, is now reporting to your credit bureaus if you want them to. And so people are using this the same way they're using the credit card, to your point, but now you're actually getting credit toward having a good score, building your credit score by using these types of platforms, which I guess cuts both ways, right? You don't actually make good on your monthly installments at some point, and all those Shein purchases come crashing down, and now you got a 600 credit score.
Other finding from this survey is that the majority of people making at least $100,000 a year agree with the following statement: I make six figures, but it doesn't go far where I live. I wonder if is this something you see in your practice, Malcolm? You're talking to tech people, they're generally high earners, but they're just having the feeling that they're really struggling financially.
Not as much, because, right. So when we say six figures, that's a very, very wide delta, right? That's
100
anyone who makes
to 900 is a lot.
Yeah. And so I think it's the people in the middle who actually feel like there's some there left at the end of every paycheck. It's the people at the bottom end of that 100, 150 that feels like they have more month than they have money. And that may be true depending on how much house you own, how much car you drive, how much education you paid for on credit, all those kind of things. And then the people on the upper end who, I mean, if you make $700,000, $800,000, $900,000, there should be something left over. The problem that a lot of the people that we talk to have is the taxes. They're just like, how can I get away from having six-figure tax bills when it's all said and done? But it's not necessarily help me. I can't figure out how to stop spending to a place that I can actually save some money.
Before we get to the next topic, I really want to thank Amazon Music, because This Time is Different is a featured podcast on their business section. Amazon Music, we are happy to be partnered with them for cross promotion. I like listening to podcasts on Amazon Music. Malcolm, do you enjoy listening to podcasts on Amazon Music?
I'm a Prime Video guy first and foremost. I'm an Audible guy second, and
that counts.
then Amazon Music. But I guess it's all in the same family.
Okay, we're so happy to get some promotional juice from them. I'm really excited about this partnership. I don't have a whole lot else to add on this. I was going to do a bit, but I don't think it would be that funny. I'd rather move on to the next topic. Other retail story, since we're talking about spending in retail, is Abercrombie Fitch. This is a company I've been following for a while. I picked up some shares a little while ago when it really got killed, and this week brought me back into the green a little bit, because the shares shot up 30% on a quarter that was just a little bit better than expected. Here's what really has drawn my eye to this stock is that this is a company, market cap is less than $5 billion. And this company took about 9% of shares outstanding this year, right back to home, bottom back. And they have the authority to do almost 1 billion more. So they have the ability to take about 20% of their shares off the market. And this company has some sales growth in Hollister primarily, which is worth getting into, because part of this, if you're betting on this company, is you're betting on the sales and tastes of a target market that is 14 to 21 years old, which I'm really bad at that. However, I like seeing a retailer that is using cash flow, not debt, and I can get into that, cash to buy back a lot of shares and is still able to maintain a little bit of growth. Yeah.
So what you're describing is essentially financial engineering at its core. And I don't mean that to sound like Abercrombie is the only company that does this. Apple is the best financial engineering company there is, hands down. One of the not best at it, I would argue, is probably Facebook on the other side, because they tend to buy shares when their stock is at all-time highs and not necessarily when it has these massive sell-offs like what's happening right now. But essentially, you're taking the free cash flow that you earn and saying, we don't want to invest in growing our stores. We don't want to invest in growing our online footprint. We don't want to invest in building AI agents to make shopping online easier and get more packages to people's front doors faster and cheaper and quicker and whatever. Instead, we're just going to buy back more shares of our outstanding stock, because as you just put together, the fewer shares there are out there in rotation, in circulation, obviously, based on the way math works, the higher our share price has to go. I don't really love that as being indicative of where the market is going, right? Because you have the people that'll argue retail is here to stay. There's nothing wrong with the consumer. You should invest in retail stocks like TJX and Target and Walmart and Home Depot and everything else ahead of the Christmas season because that's where they really make their money. Black Friday is Black Friday for a reason. And then you have the people like me that are on the opposite side of that say the consumer is in terrible shape. We just got done talking about how people who should be well enough off under normal circumstances are resorting to buy now, pay later to make regular purchases. And that means they don't have a ton of money to be spending at Abercrombie and wherever else. And so we should not be looking at those places and so depending on which side you fall on, you could see this as a positive. Maybe you see it as the company has confidence enough in their stock that they want to buy back more of it. I, on the other hand, say, if you were really that convinced that this was the time I should be investing in your company, you would be spending those dollars, as I just mentioned, building the best agentic AI bot to land on your website to help people shop this holiday season.
So not agentic AI. I think they're still building out their e-commerce business. They're also going to build about 60 new stores this year, 40 right sizes or remodels. So that is key in this. I think that they aren't just trying to do a cash squeeze out of this, because where buybacks often go wrong is you have an executive who has a stock options target at a certain dollar amount. And so they will financially engineer the stock price to get to that amount come hell or high water. And that often includes taking out debt to buy back shares. And there's a lot of retailers, and it was specifically in the late 90s and early 2000s, that got in a lot of trouble for that, where we're not spending money building out our stores. Instead, we're going to take out debt to buy back shares of Circuit City. And because we haven't spent time or attention building this out, then the stock price craters, and it doesn't matter how much stock you bought back at all-time highs. You didn't deliver real shareholder value. But there are companies that have done this successfully over long periods of time.
So you mean to tell me if I had $1 trillion pay package I was desperate to make good on, I might be in danger of taking out a ton of debt to buy back all of the shares in circulation just to hit my share price targets?
No, he's going to do that. And he's talking about Elon Musk because...
No, I'm talking hypothetically. I didn't mean anybody in particular.
It's just so he can get control of the company. But I hear your point on, you want to find companies that have more attractive growth opportunities. But I think for, my portfolio, I have a couple of shots like that. And I also like the idea of, being a trust fund baby a little bit. I want you to buy back shares on the open market from traders and just hold on to me tightly, closely, hug me for the next 3 to 5 years as you try to grow my earnings per share through this financial engineering. And could be a bad thing, could go wrong. One way this goes horribly wrong is that Abercrombie continues to not grow, and Hollister loses its touch with younger consumers, which are a fickle sort of shopping cohort, I would imagine. The things that were cool 2 years ago aren't cool today. And now we're at a point, the Siberian throat singing act I told you about earlier in the show. Malcolm, they are familiar with 6-7. So you never know how ideas are going to grow and spread and what's going to be cool and completely known 2 years from now. But I think this is a company that the question is, can you keep your earnings stable while you buy back a ton of shares? I think the answer may be yes, and I could totally be wrong. That's why I'm not putting all my money into it.
So, two things. One, I appreciate that you and I see this so differently because that's what makes a market, right? Like, you invest in companies that I would never even probably pay attention enough to make a buy or sell decision on, period. And that's what makes a market. Like, two things can be true at the same time. And as long as we all think about it that way, instead of all crowding into the same 5 trades, then we don't have what's happening right now in Bitcoin, where the share price has basically got cut in half. The price of a token has basically got cut in half. And I get all these frantic messages from strangers that are asking, what should I do now? That's one. Two, I think you might be changing my mind slightly about this one particular company, because I do think that it's specialty retail. And I believe that the nichier you are, the better shot you have at drowning out, or not drowning, but not getting lost in the shuffle or lost in the shadow of like Nvidia or Google. Because those are the two companies dominating all of the headlines right now when you talk about market news. So if you are super niche retail like this, then you do know who your target audience is. You only have to focus on serving your target audience and nobody else. Anybody who can't fit into our cut of jeans, well, we're not talking to you. And that's fine. So I do appreciate the nichiness of this particular retailer.
They've gotten a little bit better about that. They sell some jeans that are a little bit bigger now.
Okay, well, they're not Wrangler, so
yeah. Let's go to your side of the market then. You want to talk about some AI stuff, because I think
we have to.
I think there's a narrative turn on AI. This is my CNBC question, Malcolm. Is the narrative turning on the AI trade? Because I think it is. I think fund managers used to have to answer how they were investing in AI. And now I'm getting the sense that if you're investing other people's money, you got to answer how you're protecting yourself from a bubble.
Yeah, I actually don't think that's happening. I think that there are a lot of people who are considered the smart money who have a wide enough following and a wide enough audience that they are scaring retail investors who are concerned that the next 2008 style crash is coming for them and they want to be out in front of it. And the reason that I say that so confidently, the one true thing that is the metric that I use to make this determination, which means immediately after I've said this, it's going to be 100% wrong and go the other direction. But the thing that supports my hypothesis is the VIX, the volatility index, in comparison to the price of Bitcoin. So Bitcoin to me is the one true direct gauge on what the retail investor feels and believes. The fear and greed index for retail investors is Bitcoin. Like I just mentioned, it's been cut in half basically over the last few trading weeks. However, the VIX hasn't spiked at the same rate. And so institutional money managers, which make up about 80% of the overall market, the dollars invested in the overall market, aren't selling these companies at the same rate. And that says to me, we're about to see a shift where the institutional manager who has been on the wrong side of this trade for too long, like the last stat I read said something like 23 or 25% of all large cap strategies out there in the market include Nvidia. That means that 75% of fund managers who manage a large cap portfolio do not own Nvidia, which over the last 3 years has been a heck of a mistake because the stock's up 1,000% over 3 years. So this is the opportunity for those money managers who have been caught out to actually go and start to buy those shares at a attractive valuation you haven't seen in quite some time, because as the company's growing earnings, I think their last quarter, they just put up like $57 billion. The share price is also coming down, which means its forward earnings multiple is also coming down toward that of the S&P. So now it looks more reasonably priced in comparison to the overall market. And so in my opinion, this is the buying opportunity that institutional money managers are going to seize on, and you're going to see these AI names start to turn a corner.
So speaking of AI names, and I want to get to Nvidia a little bit more in a sec. How about Oracle? This was in the Financial Times by Bryce Elder. I thought this was incredibly interesting. September 10, Oracle announces a $300 billion deal with OpenAI. The question is OpenAI like the Madden curse? You get a deal with OpenAI and it turns out to be a bad idea. So September 10, Oracle announces a $300 billion deal with OpenAI. Since then, Oracle stock has shed $315 billion, and this was as of November 18, so check me on it, in market value. So that to me looks like it could be a narrative turn if the market is not exactly celebrating deals with OpenAI, which is one of the biggest names in AI.
Is that a narrative turn, or have we just decided that we don't want to carte blanche across the board anoint all companies that are supposedly leading the AI charge, right? So investors have started to ask more thoughtful questions. It's the whole reason that Sam Altman got pissed off at Brad Gerstner and jumped off the podcast. We talked about it in a previous show.
So context for that, if you didn't listen to the previous show, Brad Gerstner is a tech investor who's so much more than a tech investor. And He's interviewing Satya Nadella, CEO of Microsoft, and Sam Altman, who runs OpenAI. And he was basically saying, you make a few billion in revenue. I think it was, is it 10, something like
13.
that? 13. Thank you. And that was remembering a number off the dome, 13 billion in revenue. And you want to build $1 trillion in AI infrastructure. How are you justifying that? And he said, if you want to sell your shares, you can sell them. I don't like you. And then he was so sick of that question. Why would you even ask me that? And then he left the show a few minutes later. Him leaving the show got blown up a little bit. I think there might have been a scheduling thing that they already knew about. Who knows? But either way, Sam Altman basically had the worst possible answer to a softball layup question that he should be able to answer in his sleep. Okay, Malcolm, back to you.
I would argue, though, that was the very beginning of this narrative turn that you're talking about, which made... So before, I know you watch wrestling, so I know you know...
I watch UFC. Get it right.
You grew up watching WWF the same way that I did. True or untrue?
Untrue.
Okay. I thought we had WWF conversations in the past. I apologize for mischaracterizing your TV watching habits. Anyway, in the world of wrestling, there is this term that the wrestlers use called kayfabe, which basically means, see, now you know what I'm talking about. We all suspend our disbelief together, even though we know it is literally impossible for this guy to lay here helplessly while someone else does 8 somersaults off the turnbuckle, lands on top of him, and then the guy who just got assaulted basically in the middle of the ring somehow musters up the strength to jump up, move out of the way, and pin this person to the ground who just did the 8 somersaults, so we know how athletic they were 20 seconds ago. But we're willing to cheer for it, watch it, love it, everything else, until we turn about 18 and we say, I'm too old for this. And that's basically what was happening in the market when we talked about AI and all the mega cap tech companies. We were all willing to suspend our disbelief until one of the insiders, this is the equivalent of The Rock getting on TV and saying, hey guys, you know that thing I've been doing for the last 20 years of my life? It's all fake. That's basically what happened here. And that's the reason that you feel this vibe shift from investors who are saying, well, maybe I should be a little bit more discerning. Maybe I should scrutinize these guys a little bit more. Maybe I won't be a pariah if I happen to get on an earnings call and say, how'd you get that number? And that, I think, is what is happening now to certain companies, especially the ones that are having to load up on debt in order to make these dreams come true.
And for this conversation, maybe it's a good thing that OpenAI is private right now, because I think if they were a public company right now after that vibe shift, it would have been, I don't think their stock price would have stayed going up and to the right or even stable. I think there'd be a lot more people maybe running for the exits on that specific company.
Yes, but I and a lot of other people have fully expected them to come public in 2026.
Yeah.
And their CFO most recently was in, I want to say October. She was publicly saying out loud, I don't know if we need to go public next year. I don't know if that's going to happen. Maybe not. Probably not. Could happen. I don't know. And that, again, was the market saying, wait a minute, we had this agreement here tacitly, and now you're breaking that agreement.
Didn't she also float the idea that they need a government backstop? And then, CFO
which means then and this is a person who has public company experience, right? It's not her first time. She's not a startup CFO who happened to be attached to this rocket ship that just went out of control and she was out of her depth. Like, this person has been a public CEO for years and years. So she knows very much what you are and are not allowed to say out loud, just musing to yourself and also in front of an audience.
Shout out Sarah Fryer. Okay. The other part of this narrative, you talked about Nvidia earlier, and I read a Substack that had me on the edge of my seat a little bit. It was from Shanaka Anselm Pereira, and he wrote basically accusing Nvidia of having major, significant accounting issues. And this breaks down to a few things. Give me a sec. Customers are taking longer to pay Nvidia for their chips. This might be a problem with a lot of the circular financing deals, which is the days sales outstanding. We've made a sale and we're waiting on our customers to pay us back. That is growing. And this writer believes that Burry's short implies a conviction that Nvidia's stock will fall within 4 months, which is when these aging receivables or IOUs back to Nvidia would basically force Nvidia to make some accounting changes. So he's asking, why is it taking longer for Nvidia's customers to pay them back? The other question is, Jensen Huang has said, demand is insatiable for our chips, for our GPUs, our graphics processing units. Then if that's true, why is your inventory growing by about a third from just the previous quarter? The other questions is he thinks there was some smart money, and I'm putting smart in quotations here, exits that kind of lined up around the same time. Michael Burry, Peter Thiel's fund, SoftBank, and then also concerned with the circular financing, specifically with XAI, where, and we've talked about this on the show ad nauseum, but Nvidia invests in sort of a shell company, outside company whose main purpose is buying Nvidia chips for the other company. And so then Nvidia is able to basically book sort of, we have more equity on the books and more revenue on the books. And this could create a tailspin. The inventory questions, customers taking longer to pay them, and all at the same time, the cost of compute for renting these chips, he found, is also going down. And he's very concerned, as he should be, because if Nvidia goes down, this is what has been driving the market a lot. And I'm not supposed to say this on a podcast. I'm not smart enough to know if this guy is right, but it had me drinking my coffee a little quicker, Malcolm.
So I mean, there's a lot there.
Should I have gone one by one and let you respond, like a call and response type of thing, or do you
No, this isn't a court of law.
Argument?
This is not a court of law. The one thing I will say, just to make sure that journalistically we are on the right side of right, shell company, no. Holding company, yes.
Holding, thank you. Thank you for that. I meant holding company the whole time. Maybe our engineer, Tim Sparks, will just have me saying holding company, something like that, to really make it clear that I meant something else. Thank you.
But aside from that, I'm going to pull out the one key piece of this that I think should matter to investors listening to everything you just said, which is the question of why is inventory growing by 32% if there is also insatiable demand from all of your customers for the thing that you sell? And the thing that I will point out, I'm glad that this was part of the analysis, because this is what I have been on TV saying to viewers for over a year, is the only dynamic that matters as far as Nvidia is concerned. This is the one key metric that you should be paying attention to. You may even want to pull over your car and write this down if you're listening to this on your way to work. For the last 2 years, Nvidia's receivables have been twice the size of their inventory, which means that they have 2 times the amount of demand than they have supply. So as you're seeing inventories grow, you're also seeing the accounts receivable line grow for this company. And that makes sense when they just reported that their revenues grew. I think the number was 62%, if I remember correctly, year over year, which means then that everything is growing in the right direction. It's literally going up and to the right on a chart. The one exception to this, which did jump out to me the last time I did this quick analysis to make sure that I still want to be a shareholder, is that 2-to-1 ratio no longer exists as of the last quarter. It's something like 1.8 over 1 instead of 2/1. So still not anything significant enough to make me want to jump out of the shares and say this whole thing is coming to an end and there's not enough there in the trade. But I will admit it got my attention and it's something I'll keep an eye on. But one data point doesn't make a trend.
So you are not ready to hit the panic button, and you wanted listeners to pull their cars over for a fraction going from 2 to 1.8. I don't know.
No. I want them to focus on that one metric with me, because in my opinion, that is the thing that tells you whether demand has shifted over to Amazon and its Trainium chips, if it's gone to the Google Gemini camp, if it's gone to the Broadcom camp, if it's gone anywhere other than Nvidia is the one true love of all of the AI build out. That's where you'll find the answer.
Okay, so don't you can get back on the road now. you can turn off your emergency lights, put away your notebook. because I got some word vomit on. Or is there anything else on the AI stuff you want to chat about before I get to the next topic?
I thought this was breaking news, and you just yawned in my face.
I don't think it was breaking news. You said 2 to 1.8. It's all right.
Yeah. I thought I was giving the cheat code on how you know when it's time to sell your Nvidia shares, and you just said,
Yeah. But you didn't give the panic button number. What's the panic button number? 1.5, 1.8.
Well, I think the next 2 quarters, if that trend line I mentioned starts to go back down instead of up and to the right, that's where I start to get concerned. So yeah, if we go to 1.5, 1.6, and then down again to 1.3, 1.2, that is concerning to me.
You gave the ingredients for the recipe, but you didn't give the cook time.
I apologize.
To continue the overwrought metaphors of this.
Thank you, Chef Ramsay. I missed that part.
Yes, Chef.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
I want to talk a little bit about Paramount. I've been threatening to talk about Paramount on the last 3 shows. I think we talked about it on the first show. But today, as we record this on Monday, as you listen to this, the bids will already have been submitted. Second bids for Warner Brothers Discovery. And Paramount is in a 3-horse race to eat this thing. They're also in it with Comcast and Netflix. And I think it's Ellison and possibly the Saudi Arabian Public Investment Fund, although Paramount denies that. There's been reporting, I think, from Variety that they're involved. They're basically, Paramount said, we're not involved with them, but also everything we're doing is private, so we couldn't possibly comment on it. So it's kind of, we'll see. Maybe I'll have to eat my words on that. I want to make it clear, though, to the Ellison family, father and son, you all deny it. And I'm saying this is an allegation that could totally be false. But anyway, Paramount is in a 3-horse race to buy Warner Brothers Discovery, Comcast, Netflix, or the other 2. And I think Paramount's going to do it. Could totally be wrong about this, but here's why. Comcast, they just want the film and streaming assets. Netflix doesn't want any of the streaming assets. They just want the film studio. Ellison, father and son, they're going to take the full meal, and that includes the television channels. The other part of this, President Trump, he likes Ellison's. He likes what they're doing with CBS News. He might like what they would do with CNN. The question is this actually a good thing? Because there's been a lot of really expensive media acquisitions in the past that haven't exactly played out. But if Paramount gets it, this is sort of the thesis that streaming is moving closer to a 2, maybe 3-horse race, or winner, like 2 or 3 players take all, similar to your big tech cloud computing stuff. Mm-hmm. But also sometimes really expensive media acquisitions don't pay out. I don't know. I'm kind of mixed on this one, Malcolm. What do you think?
I think it's interesting that this is where we started. So maybe we're returning home. Like there was a time when NBC, ABC, and CBS were the only networks on TV. And then I think Fox showed up in like the late 70s, and took it to 4. But there were like just 3 dominant networks for a very long time from the advent of television. And so it's interesting to me that we're threatening to go from that to cable, which gave us like 50 to 100 individual channels. And then you tack on sports and we got to like 200 channels. Then we got to all these disparate streaming services that when you finally subscribe to all of them to get the thing that you want to see, you end up paying more for cable, more than you used to pay for cable. So now you're pissed off about that. At least I am. And now we're threatening to go back to a place where all of those app icons all over the home screen when I turn on Apple TV are going to go back to 3 apps that I have to use basically to watch what I want to watch. And then if you think about the political skew of a lot of what tends to be on those networks, maybe I don't even want to watch all three. I only want to watch one or two. For one, I'm in support of that because I don't want to have to find the game that I want to watch on TV based on the app that it's streaming on. But then separately from that, it's coming back home, right? Like what is old is new again, basically, after an acquisition like this. Because even if this one doesn't go this way, the writing is on the wall that this is the direction that we're headed, probably by the end of the decade.
Yeah. And I think it will go this way because you have the political side. And also, if I were on the side of Warner Brothers Discovery, do I want to deal? And maybe the answer is yes. Maybe these people are wolves who just like making deals. Do I really want to deal with a buyer who only wants to take the top of the muffin, right? They want to come in and eat the top of the muffin and then just kind of hand me back the aging cable television assets where
that's how you used to do these kinds of deals in old media. Like there were people once upon a time who were so fixated on, I care so much about the brand, or I care so much about media in general, or I care so much about journalistic integrity, dare I say, that it matters to me who the buyer is that comes in and takes this thing. And so I'd rather sell the parts to the people who are going to treat them the best. I want them to go to a good home. And I think in this case, because everything is so shareholder interest first, now it's really just who's going to cut the biggest check. And so to your point, I don't think it makes sense from a mathematical standpoint, from a maximizing return on investment standpoint, for us to sell this thing for parts. It makes much more sense to sell it as one huge package deal. And as you've been alluding to, there's only one person or people or group willing to cut that check. And so it's kind of obvious where this whole thing lands.
So anyway, I think I don't have a big position in Paramount relative for me, but it's something that I may continue adding to, something I'm definitely keeping an eye on. And I think it's one of those things where who are the top companies that are going to win in media in 2028, 2035? And it seems to be rolling in the direction of Paramount a little bit.
As somebody who was so invested in when the heck is Landman coming back on TV, I'm just going wherever Taylor Sheridan's going. So I don't care what network wins in the end, as long as they allow him to keep making great cowboy content.
So you've got Paramount until 2028, and then he'll see you over at Peacock unless Peacock gets eaten up as well. The other media company we have not talked about on the show is Disney, which I think is also interesting. I think Paramount's more interesting, but I think Disney is interesting precisely because Disney, historically, it's been a tech company, kind of. And right now its multiples are historically low. And when you look, I've been watching this YouTube series called Defunctland about the history of Disney animatronics. I think it's really interesting. But one of the themes of this is that Disney has always moved in cycles. It's kind of its popularity is a little bit cyclical, where people are down and out on Disney right now because they've screwed up the Star Wars franchise quite a bit. There's still a lot of questions. Bob Iger says that he's leaving in early 2026. Stop me if you've heard that one before, though. And but Disney has also been through this in the late 90s, where before they bought Pixar, their animation department was really struggling. A lot of questions about it. And right now I'm looking at it precisely because Disney is in that sort of down cycle in terms of popularity from investors. Its price to book value, if that's one way you want to look at the value of all of its characters and IP, historically lowish, around 1.8. But it's an elite brand. 2 of the top 3 movies this year are going to come from Disney. Zootopia 2 just had, I think it was the biggest opening from an animated movie ever. It's going to have Avatar in December. So, it went a little woke, but it's not appearing to go totally broke, Malcolm. And the thing I can't totally get to, though, is that there does appear to be a little mismanagement. I mean, you look at the Star Wars library. People aren't that interested in Star Wars right now. They're losing money on Star Wars television shows. ESPN, we talked about sports. ESPN's in decline, and that doesn't seem to be reversing as they continue to lose a bunch of sports rights. And the only real growth engine is its parks business. And for Disney, the next park they are opening, and this is one that they're, someone else is putting up the money, it's in Abu Dhabi. And a lot of theme parks in Abu Dhabi, maybe if you build it, they will come for Disney. But if you go on YouTube, a lot of those parks are kind of a liminal space. There's not a ton of people going out to Abu Dhabi to go to the theme parks. Maybe Ferrari World is the exception, but I see these YouTube videos of just almost completely empty indoor theme parks over there. But anyway, that's why I'm really mixed on Disney. That's why I'm not adding to it, but it's sort of starting to draw my eye a little bit, is maybe its problems are completely known and maybe a little overrated by the market.
I've never been able to invest in Disney. Disney to me is like that person you have to invite to your dinner party just because they have the most interesting friends. And so they have to come along just because or they have like a really great spouse that you want to come to your party because that person's the life of the party. So I want
you to keep that going. Why do you want to invite them just to see their spouse?
Well, because their spouse is the one who's actually entertaining, and they're the wet blanket you just put up with because you want to be able to have that. Are you a Curb Your Enthusiasm fan?
Yeah.
So the term.
You can guess that one.
You know the term middling. Then you want their spouse there because that person can middle, right? You don't want Disney at your table to sit in the middle and have to carry the conversation in both directions because they're terrible at it. But the Avengers is interesting. Star Wars is interesting. ESPN, for the most part, even though Stephen A. Smith is like the most important person there to the franchise now. And I mean, if you've heard him yell into the mic once, you've heard it a million times. It gets old after a while. But he/ESPN are interesting. That's it. Disney itself, unless I'm a 5-year-old little girl, I don't really care that much about their traditional properties the same way I used to. It's really about all the other stuff that they've acquired along the way that makes them so fascinating.
No, Disney park attendance is doing just fine, and adults are included on that. That is you personally, Malcolm. You are not getting your mouse ears and going down to Florida or Shanghai Disneyland or Tokyo.
Well, I might
Disneyland.
have to as the parent of a 5-year-old little girl.
Okay. Well, is she interested in Disney?
Oh my God, yes.
Okay. Well, then you're not the target market for it, and
I'm the target wallet for it, though.
Yeah.
Yeah, they care about my wallet, and they know that the kid brings the parent kicking and screaming.
So if you have an opinion on Disney, actually a good place to let us know. Let's say our email, thistimepod@gmail.com. If there's other topics or companies you want us to talk about on the show, that's a good place to let us know. And you can find me. I'm at Rick So Slick on X, Ricky Mulvey on LinkedIn, Malcolm on Money. That's Malcolm Ethridge. He's Malcolm on Money, wherever you want to find him. And we will see you next week. Thanks for joining us.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.